Thanks, guys, for being here.
Thanks for coming. Let's just scope out, the knowledge level in here. How many people have invested into cryptocurrencies?
Hands up if you own crypto.
All right, so about 50%.
Hands up, people in the house here who have done anything with decentralized finance. Okay,
all
we
right,
got some.
so a few people. Okay, so the people are pretty
There's some exposure.
basic, yeah. So let's get it started. So what is cryptocurrencies, and is this the end of the financial banking system?
As we know it.
So let's introduce ourselves. I'm Danosch.
And us, Bhurtun, we run the Crypto Sheikhs podcast. We also run Arts DAO. If you were in our session earlier, we invest in NFTs and we launch NFT projects. I'm a former lawyer, former crypto lawyer. Danosch, you are everything.
I'm a former gangster.
You're a former gangster, former thug, rapper,
No, so I have a commodity and chemicals trading company, and been an investor in cryptocurrencies since end of 2016.
Yeah.
And we recently got into NFTs as well. All right, so let's move.
Blockchain. Okay, first things first, we have to understand how blockchain works. And because I said this earlier, think about it as a new legal system which underpins the new financial system that's being built, right? Cryptocurrencies exist on the blockchain. And the way I like to explain blockchain is often like a book. So imagine you've got this book, right? And every time, books have pages, right? And every time you do a transaction, something is written in that book, okay? And eventually the page gets filled. So you have to then flip the page to move on to the next page, right? And this is effectively, the first page is a block. The second page is like a new block. And so the term blockchain comes from a chain of blocks, which each block's representing transactions. Blockchains itself is just a database. Okay, a database which exists on the internet. And the key part about blockchain is that it's a distributed database across the world. One of the key aspects of why we're in this space and why crypto was created with Bitcoin was it's decentralized. We'll go into a little more detail on that on the next few slides.
Yes, I like this example. There was a guest on our podcast that used this as an example to explain the blockchain. Imagine trying to explain to your grandmother what a blockchain is. Essentially, imagine having a credit card and you go to the store and you swipe that credit card. Now, essentially, what happens in the background in the blockchain is that transaction is not going to get registered on your bank statement unless it's becoming verified. So the blockchain underpins the transactional systems. It is very safe. So what happens in the background? Imagine having millions of accountants all around the world that are using all the computers and the computing power they have to verify that transaction is real. So what does that mean? That means that the transaction that is being released onto the blockchain has to be mined. So we get into mining. What is mining? Mining is, imagine all of us here in the room. I want to send money to Anas, or I want to do a transaction. I swipe my credit card at the store. All of you are helping to keep the blockchain running by giving computer power in your servers. What that does is there's a cryptographic problem that is being solved. So what is cryptography? We have to go back to the Second World War when the English people, the English.
Yeah, we're fighting the Nazis.
We're fighting the Nazis, and they were trying to hack the codes that they were sending. They were sending messages that were cryptographic.
So the Nazis were sending cryptographic codes, and so cryptography is effectively cryptography
it's a coding.
is a type of code which password protects something. And so the whole reason cryptocurrency comes from that, right? Cryptography and currency come together. It's a currency that is built on cryptography so that it cannot be hacked very easily, right? If we're going to be moving large sums of money between different people all over the world, we need to ensure that this basis is cryptographically secured so that it cannot be hacked.
So every transaction that I make has a cryptographic problem that you need to solve. And solving that problem is impossible by using one computer. So you need a network of computers all around the world working together to solve that problem. And once that problem has been solved, the transaction is released. And that's why a transaction might sometimes take 10 minutes, might sometimes take 30 minutes, because that code needs to be solved. And when it's solved, all of you in here randomly, someone is randomly selected and given a reward for helping to contribute to that blockchain.
Well, yeah, so the importance of the technicals around this are less important. What's more important is the concept of decentralization. Okay, so I want to draw two pictures here. We have decentralized trust and we have centralized trust. Okay, currently in the system that we live in right now, we live in a centralized system. What does that mean? All of us have bank accounts and we are reliant on the banking system to do anything. If something goes wrong, we have to call our banker. Let's say we send money. The money doesn't go to where you want it to go. We have to rely on the banker providing us the analysis that this has happened for X reason. And there's been a lot of problems like this where people have sent money and you sort of ask your bank and they're like, oh, I don't know where it went. I have to go find it out. This what Bitcoin and the guys who created blockchain wanted to sort of do, but by challenging this existing paradigm, was create a system where we did not have to rely on one party, a centralized party, where as a group, democratically, all of us can be players in this system. And that's where we get into decentralized trust. Trust here is important, right? Because we have to trust one institution. But what if we could stop trusting one institution? We could trust that the software ensures everyone
in the network
who's a network. The network ensures that we don't have to rely on one entity. So if a collapse of a bank does not mean you have to lose your money. That's the key part about holding crypto. When you hold crypto, you own it yourself. You don't need a third-party bank to hold it on your behalf.
It's completely decentralized. So let's say your server breaks down, the rest of the network will still run. And that's the beauty of the blockchain. It's you cannot destroy it.
So yeah, I just kind of was
so let's talk about some of the issues we're facing today with banks. So when I make a payment, I have to trust that the bank is sending my payments to the right place. So I run a business in the traditional world, and many times when we make cross-border transactions, the money disappears. It doesn't disappear, but it doesn't reach the bank account. And then I have to go to the bank and say, where the hell did my money go? And they have to start an investigation, and that requires my time. I need to fill out forms. I need to go to the bank branch. And 10 days later, I might know where the money is, and by that time, my customer is pissed off because he hasn't received his goods because I haven't been able to buy them from my supplier. So that centralization it's a filter, and we have to trust the banks that they are doing their jobs right. And how many times have we not seen that banks have failed and disappeared with people's money?
Exactly. Banks fail all the time.
Look at what happened in Lebanon. People are on the doorstep of the banks wanting their money back, but there's no one there to answer.
I have loads of friends like this in Lebanon who held US dollars in their Lebanese accounts and they were frozen because the bank doesn't have the liquidity to meet those payments.
Exactly.
But more importantly, there's something else here, which is a sense of intrusion. So I bank with an English bank, which I'm not going to name, but recently I had I always use this example, but recently I sent money to my dad from this English bank account. He's based in another country. And the bank phoned me up and said they queried this transaction. It wasn't for a huge amount, it was like $4,000. But it was a transaction that I hadn't done before, and they were just curious, why am I making this transaction? They started asking me a lot more questions, even though it was my father, and I explained this to them. I had to supply documents showing this is my dad, look, we're related, blah, blah, blah. We then, subsequently, I had to be KYC'd even more. They asked me my salary, where are the sources of my income, all kinds of very detailed information. Now this is, I completely agree. Look, there are reasonable reasons for ensuring your client, if you're a bank account, you want to ensure that they're clean and all that stuff. But as a person right now, to have to and deal with this level of intrusion, I personally found it to be an invasion of my privacy, to ask questions about what I do, where I get my money, even though it was just a normal salary, I was working at a normal company. In crypto, because everything is decentralized, when you send money to somebody else, there's nobody who can stop you from sending money to that person. So if I want to transact right now with Danosch, right? Just like me moving cash, I got some dollars here. Oh yeah, you got some dollars. Just like in the real world, you're giving me money physically like this. I can do this digitally through crypto. And you know, nobody can come in between and tell him, one, I want a transaction cost of like $50 if it's a Swift transfer, or two, stop me from making this transaction. So in a way, it goes back to this old school idea of property rights and freedom of contract.
And there's another thing as well. There's around 3 billion people that are currently unbanked, which is crazy if you think about it. And if these people would like to open up a bank account,
they can't.
They can't. Why? Because they don't have the right documents.
They don't meet KYC.
They don't meet the KYC.
They don't have enough credit.
Loads of reasons. And
it's an elitist system.
The decentralized financial system solves for that problem. What it does not discriminate. It doesn't discriminate on your skin color, on your race, where you're from, what your background is, your financial situation. If you just fulfill the criteria of having a phone, and you can connect to the blockchain, you're fine.
You can receive crypto easily, exactly.
And another aspect,
I wanted to show this image because this is, I think, in Canary Wharf in London, where I used to work a long time ago. This image reflects the sizable capacity of banking, i.e. they're huge institutions employing thousands of people. What's really quite interesting, and we're going to go into this through decentralized finance, is that a lot of these things, a lot of the reasons why all of you are paying loads of money to use your bank account, also the reason why when you put your money in your bank, you don't earn much interest, because you have to pay the salaries of all these people. The truth is, in crypto, you don't need to do this. Banking, lending, all these different activities, they can be done through smart contracts employing a maximum of 30 people. So this 1,300 people is excess fat that can be excised, in my view.
Yeah, so basically what decentralized finance means is that everyone in here can become their own bank. If you hold crypto in your wallet, you can lend it out to people, you can earn interest rate on it, but you can also borrow. So if you have crypto in your wallet and it's there or on a financial platform in a protocol where it's locked, you can then unlock money to use as a loan. You can take a loan and you obviously have to pay an interest rate, but this is giving so much freedom to anyone that is one way or another connected to the DeFi space.
So let's talk about the philosophy now of crypto a little more. It's very important. Obviously, we've moved through a lot of different kinds of money, and what's interesting is right now we live in what's called a fiat world, a world where money is not backed by anything. This is actually something quite novel. Well, it's not novel. It's happened throughout history, but it's always happened in cycles. If any of you guys follow Ray Dalio, he's a very, very famous investor. He writes about this in his recent book, Principles of the New World or something. Yeah. So we used to live in a world where we had silver, gold. Silver dominated the monetary system in China for thousands of years. It then became gold throughout Europe and in the United States, right? And so we had the gold standard in England until effectively we saw the power move from World War II to America. What's interesting about the history of money is we see these dynasties of institutions, right? There's a reserve currency that normally occupies the dominant currency in history. So previously, if we look back, we had the Dutch, who had a period where their currency was the reserve currency. We then had the French franc, then England with the pound, and now of course we have the US dollar. Throughout this period, what's interesting is we've seen cycles where they've gone from being backed to something to being backed by nothing, to become fiat. Often this is a result of excess spending on wars, etc., which then lead to the fiat system being pushed forward. So most recently not recently, in 1971, the United States took the dollar off the gold standard, right? You can see up there, $20 in gold payable to the bearer of in demand. What this basically means is you could bring your dollar to the Federal Reserve and claim gold as redemption. This has now been removed. So we've been living in a fiat world ever since 1971. What's interesting about this is since that date, the amount of money being printed is astronomical. And what it's also caused at the same time is an increase in income inequality between people, because money being printed at the top does not get distributed equally across the entire sort of value chain in society.
Yeah, so there's around, I think 85 or 80% of all of the US dollars is digital. So it's just a print, it's just basically a press of a button and they print trillions of dollars. And that has implications. That's why Bitcoin was created. That is why Bitcoin is limited in supply. So, and one more thing is, if you look throughout history, currencies haven't survived for more than 100 years. And the currencies we see today in the fiat world, the euro, the dollar, they are reaching their 100-year mark. So we are seeing a huge shift in that space.
I want to talk about this as a very important subject because inflation is one of the leading causes for currencies to fail, but also serious ramifications for society. Let's look back at World War II. The causes of World War II can be rooted in what happened to the Deutschmark. When they start, so the Deutschmark used to be backed by gold. What happened after World War I? After the emperor was ousted, they had to print their way out to fund the liabilities of World War I. So they took the Deutschmark off the gold standard and basically sold all their gold to the Allied troops, the Western countries that occupied Germany, right? That led to a period between the 20s where they were printing Deutschmarks to oblivion. What happened? Well, it led to huge income inequality in Germany.
Wheelbarrows
the wheelbarrow society came in, and what happened right after? The rise of Hitler, right? And we had World War II. In fact, if you look back in history, whenever there has been rampant printing of money, we have seen major wars
Inflation.
come through. We've seen this in the French Revolution.
Yeah.
The French Revolution in the 1700s, the same thing happened. It led to the overthrow of the aristocracy. All of them got, guillotined. If we go back further to Rome, so the Roman coin used to be gold and silver. What happened was they started clipping the gold off to cause inflation and replacing them with bronze. This eventually led to the Ides of March, leading to the collapse of Rome down the line.
We hope we're not going to experience any big wars during our lifetime. But
we hope so.
Yeah, but if you look at history and if you look at some of the predictions Ray Dalio has made, it is very likely we're going to see big conflicts in the relatively near future.
Because of this, because of money being printed. So this is an important thing. This is what effectively caused the creation of Bitcoin. The chancellor on the brink of a second bailout for banks. This happened in 2008, 2009, and it became a key rallying call because it was included in the Genesis block for Bitcoin. So Bitcoin's first block had a message, the Times, Jan 2009, Chancellor on brink of second bailout for banks. So you can see the philosophy of where this cryptocurrency was built upon. It was built on a view that the existing system cannot be reliable because it causes inflation. Bitcoin was created to be capped at 21 million so that it could become a hedge to inflation.
It's actually quite funny because it says the Times, 3rd of Jan 2009, Chancellor on brink of second bailout for Banksy. So obviously whoever created Bitcoin was a big Banksy supporter, if not Banksy himself.
But I also wanted to talk about a couple of things here about money, right? Money has a number of characteristics which are important, which have stood the test of time. The first of which is durability. So it has to be capable of lasting. So if I go to the supermarket, it cannot disintegrate. So like bread, that can't be money, right? Because it's consumable. It has to last. Portability. It has to be capable of being held in my pocket because otherwise how can I bring it from one place to another, right? Divisibility. So there needs to be denominations. So $1 can be split into cents. It makes sense when we want to buy goods that are divisible in denominations. Uniformity. We talked about this briefly with our NFT chat, but interchangeability. My $1 needs to be the same as his $1, right? It cannot be my bread for his seashell. That doesn't really work. Limited in supply, key point. What we were referencing earlier, if there's an oversupply of money, but very, very low demand, you have inflation. Traditionally, if you want to save money and you want to put money underneath the covers of your house or whatever, you should expect that 50 years from now that money still holds its value. Otherwise, you cannot reliably trust that money as a valid form of money. So I have a good example of this. My dad, he came into some savings from his grandfather in the 1990s. He came into a sum of about $100,000 at that time. And if you think about it now, I looked at some data on what that $100,000 would be worth today, from 1990. If you look at that, it's almost close to $48,000. So in that period of time, it's lost 50% of its value due to inflation. So the equivalent of $100,000 back then, to have that buying power, you would need to have effectively $200,000 in today's money, right? So that again shows the fact that holding cash is actually a very, very problematic. I think it's getting worse now because more money is being printed. From the 90s until now, the amount of printing that happened does not even compare to the amount of printing that happened last year alone, where I think 40% of US dollars were printed. Yeah. In the entire supply.
Yeah. And one of the things that Ray Dalio, so he's one of my big role models, says it's very dangerous to hold cash because with the amount of money printing happening right now, all assets are expected to increase in value. So keeping your money as cash in your bank account is not gonna help you to increase your capital.
So the last point, acceptability, right? Money has to be acceptable. So the US dollar is the accepted reserve currency. Now I wanted to put here by saying, can Bitcoin or other cryptos become money? Can they be real money? And in my view, they satisfy almost all of these. Durability. Well, there's no question of durability because it's digital. You can send money we're living increasingly in a digital world where we all have smartphones. Even in developing countries, smartphones are some of the first things people acquire before any other kinds of goods, right? So it's very easy to move money that way. Portability is obviously infinitely
it's portable. You can move it from this location to another very easily. It's not like gold.
Think about holding cash and you want to pay for a house. You can't pay for cash using, wads of cash, but you can do that very easily this way, right? Divisibility. Bitcoin or crypto is far more divisible than ordinary cash because it's almost infinitely divisible, right? Into multiple millionths of a decimal place. Uniformity. One Bitcoin is one Bitcoin. One Ethereum is one Ethereum. There's no difference there. Limited in supply certainly satisfies that, with Bitcoin being capped at 21 million. And now the key question centering here is acceptability, right? Will Bitcoin become an acceptable currency in the future? Now, we have seen that very interestingly this year, the first country being El Salvador. And it's curious to see, I'm going to be talking about this in my panel later on legal. I'm doing a legal panel where we'll be discussing this with two other lawyers. To what extent will we see the acceptability of cryptocurrencies as legal tender in the future?
We are seeing more countries subscribing to the idea to have Bitcoin as a legal tender, but we haven't seen, it unfolding yet. But it is enough that one big country actually adopts Bitcoin as a legal tender for others to have to follow. So this is just a quick chart. I actually stole it from a guy called Dr. Farzam Kamalabadi from the Future Group. So what this describes is, if you look at the Rockefellers, Kanu, these guys, when they were making their fortunes, it took them on average 100 to 200 years to amass that type of fortune of 30 to 50 billion dollars, and their interest, their returns was somewhere around 5 to 30% per year. As things progressed, we saw the stock market, and then we moved into the internet era with Jack Ma, Alibaba, Google, all these big companies. We saw this time to create that wealth started to decrease. And as we are moving into the blockchain space, if you look at Ethereum, if you look at Vitalik Buterin, it took him 5 years to amass the same type of wealth that it took someone else 100 to 200 years before.
That's
to
incredible.
Amass. And this is just going to change with the development of technology, with the development of blockchain solutions. We see wealth being created at a rapid speed, and this is a once-in-a-lifetime opportunity for everyone in here to think about, what problems are there in the world that blockchain can help to solve, and how can I be part of it? Because it's a very interesting space. It's moving incredibly fast, and there's also a lot of opportunity for high returns.
So I wanted to share this chart just to show some of the crazy. This is somewhat outdated right now. It's a couple months back, but some of the most interesting projects that we've seen this year in the blockchain space. So I referenced in my NFT talk earlier, Axie Infinity. That change year to date is actually not fully updated. It says 22,000%. It's actually up 203,000%. And that's because what they've done is they've built a video game that effectively connected very well with large numbers of people. They built a community around their works, and people there's real utility behind the game, right? People need to buy these NFTs and the tokens in the game to play it. And people love the game because it's actually a lot of fun. So clear utilities here in that sense. A lot of these fantastic returns, though, have come from the gaming industry.
Metaverse projects.
So you can see Gala. Gala is also another gaming token. But we're also seeing other cool projects like Solana. Solana, compared to Ethereum, they're up. I think here it says 11,000%. It's probably higher than that. And so many of these coins, there are many coins in the industry that are scams, I will say. And you know, right now, what's incredibly interesting about this space is because it's so because it's a money grab opportunity. You have to think about, you know, what utility is that coin really sort of proposing for its owners. And we due diligence is very important, understanding the team. It's just like
research.
It's just like VC investing. If you invest in startups, you know, you don't expect every startup to make it, right? Because some of the products that come out by these startups, they absolutely fail, right? It's the same thing here. These guys all have different visions for how they foresee the world. Polygon, a very interesting, you know, token they're building on top of Ethereum to reduce gas fees. You know, they could become irrelevant in the future if Ethereum itself, Ethereum 2.0, becomes efficient anyway, right? What's the purpose of using Matic or Polygon if you have Ethereum which can be effective with its gas prices? So I thought I'd share this. A lot of these coins are very, very interesting coins. I'm very much invested in many of these: Terra, Cadena, Gala, Polygon. All of these are great projects in the space, building things across DeFi, gaming, metaverse, and also other utilities.
I also want to say that this is a very extreme slide. Don't expect to get into crypto and earning these returns. It's very important to understand the risks of investing in coins that you don't fully understand. So always make sure you do a lot of research. You really understand what you're putting your money into.
And yeah, don't expect it to be a get-rich-quick scheme either, right? Buy into the token because you believe in the thesis of that token, right? So why are we buying Bitcoin? Because it's digital gold, right? We buy it as a hedge to inflation against the US dollar. And you don't expect to necessarily get rich on Bitcoin, but you expect to hold the value of your money across a longer period of time.
And crypto is a diversification. If you're a traditional investor and you're not interested, you know, that much in crypto, do diversify. It is a space that is going to have significant growth over the next coming years. So you have to have exposure to it. It is the future of how financial systems are operated. And as you can see from this chart, it's quite interesting. The decentralized finance space is growing at a very rapid pace. The DeFi world, if you look at this chart, so this is Aave. No, this is the complete DeFi.
This is the total value locked in USD in DeFi at the moment. This is somewhat out of date because it's actually higher, but we've seen a lot of growth. This chart doesn't actually show. I couldn't get the 1 year chart. This is the 90-day chart, but we've actually gone from a couple $1 billion to, you know, almost $80 billion locked in DeFi. So people are locking their money in decentralized finance in the same way that people are locking money in their banks. So why do you guys keep money in your banks?
Because to earn interest.
One, you earn interest, but two, it's the only way for you to transact right now.
Actually, you don't earn interest.
Yeah, you don't.
So let me tell you a fun story. I had money in a Euro account, and one day I was looking at my bank statement, and I realized that, you know, I had a negative interest charge on the statement. So I looked into it and I realized that, wait, the bank is charging me money to keep my money in a Euro account because the Euro interest rate is below zero. that doesn't
Think
make
about
any,
this.
that doesn't make any sense.
I want the audience to think about this. You are paying money to a bank for holding your money.
They are working with your money. They are using your money in the background, lending it out, earning lots of interest on it. But I'm giving it to them
For
to keep it for me, and I have to pay them.
So you're paying them for the privilege to earn money on your money.
It's
So in the DeFi space, what's interesting is because DeFi doesn't have that middleman, you're able to claim a lot more of that interest for yourself.
So you saw that picture from Canary Wharf with all the buildings. In DeFi, you don't have buildings, you don't have skyscrapers, you don't have all the employees it takes to run a bank. It's enough with a team of 20 developers to set up smart contracts and create your own blockchain and create a DeFi protocol. That's all that is needed. And that's the beauty of this. The beauty is that you can earn, first of all, if you have funds in your wallet, you can earn interest rates that are far more attractive than any other bank can offer you
close
today.
to 5%, but in some protocols you can earn 8. Actually, last year was a great time for this. If you, this is why I say getting into this space early now is a great idea. Last year I was earning 12% interest on my US dollars. So you can hold USDC, which is a stable coin, USDT. I was holding these in DeFi platforms and also other types of lending platforms, and I was earning 12% on them, just interest. Now that interest rate has actually gone down now as we've seen more people come in, right? And I think as more people come in, we probably will begin to see this begin to taper down towards 5, 4, whatever percent. But it's not going to go to 0 because there's no bank in there now. There's no negative interest rate that can be applied necessarily in this industry because the centralized banking systems don't apply in crypto in the same way. Yeah, it's completely disconnected.
All right, guys. It was a pleasure to have you. Thank you so much for joining in. We hope you really enjoyed the session.
Yeah.
So let me just give you a quick just break down a shout out to the Crypto Sheikhs podcast. So we run a podcast called the Crypto Sheikhs podcast. It is on Spotify, YouTube, Apple, wherever you want to find it. Also, make sure you follow our Instagram page. We share a lot of educational content because our mission here is to help simplify crypto for everyday people, help to spread the message about crypto and make things easy. Thank you so much.
Thank you so much.
Thank you.